Deutsche Bank AG Chief Executive Officer John Cryan is getting no closer to delivering the growth investors are craving for. The Frankfurt-based lender on Thursday reported a 30% slump in third-quarter trading revenue, twice as much as the decline at its U.S. peers. The drop drove a third straight quarter of revenue contraction at Europe's largest investment bank and overshadowed a surge in net income, which more than doubled to €647 million, $766 million, on lower expenses. "These aren't the kind of numbers you want to keep seeing," said Markus Riesselmann, an analyst at independent research in Frankfurt who recommends investors buy the shares. "The longer this goes on, the harder it gets to believe management's hopes for a recovery. We cannot see another 2 or 3 quarters like this." Chief Executive Officer Cryan, 56, has struggled to deliver on a pledge made in March when he unveiled the bank's third strategy in as many years to return to controlled growth. While he settled legacy misconduct cases, reduced risk in the securities unit and raised fresh capital, the bank hasn't won back all clients who reduced business last year. That's made an industry-wide slump in trading worse for Germany's largest lender and prompted some investors to say they may stop backing him unless they see progress by next year. "We are convinced that the benefits of our efforts will step by step become more apparent in the coming quarters and years," Cryan said in a statement. Revenue was hurt by a challenging trading environment that continued in the fourth quarter. Investor pressure. Deutsche Bank shares fell 2.7% at 9:46 a.m. in Frankfurt. They had lost 5.6% this year through Wednesday, the sixth worst performance among the 44 members of the Bloomberg Europe 500 Banks and Financial Services Index. 3 of the 10 largest stakeholders in the bank, speaking earlier this month on condition of anonymity, said they want to see a turnaround in the next few quarters, particularly in the trading business, to continue to back Cryan. Revenue has fallen in all but 2 quarters since he took over in mid-2015 and declined 10% in the third quarter to €6.78 billion. While top-line growth remains elusive, Cryan said a plan to sell parts of the asset management business and combine the bank's consumer banking units remains on track. Deutsche Bank will integrate its post-bank retail business with its private and commercial bank by the end of the second quarter, it said today, though both brands will continue to operate. The lender expects annual cost savings from the combination of approximately €900 million from 2022 and cost of about €1.9 billion in restructuring and other investments. The lender also said it will absorb Sal. Oppenheim's wealth management business into its own business in the first quarter of 2018, and that the brand will cease to exist. Cryan said in a memo to staff that the bank was unable to restore the brand's strength after acquiring it. Cost cuts. Deutsche Bank's private and commercial banking unit saw pre-tax profit rise 78% in the third quarter from a year earlier as asset sales boosted revenue and costs fell. Profit at Deutsche Asset Management, in which the company plans to sell shares to the public, fell 9% after a gain in the year earlier period wasn't repeated. The unit attracted €4 billion of net new assets, mainly driven by liquidity product inflows in the Americas and Germany. Cost cuts, meanwhile, are helping boost the bottom line. Headcount declined by about 4,000 over the past 12 months, with the impact on costs partly offset by higher accruals for variable compensation as the bank seeks to attract and retain talent following the biggest bonus cuts in its recent history. Overall, non-interest expenses fell by 14%. "We're satisfied to see the restructuring process moving ahead with the plans for the asset management unit and post-bank integration. Costs are also coming down, both in terms of legal cases and their operating base," said Ingo Fraumann, an analyst at Landsbank Baden-Württemberg who has a hold recommendation on the shares. "That's all good, but it is too early to say we're seeing a complete turnaround." Goldman hire. Deutsche Bank this month hired Paul Huckrow, a former Goldman Sachs Group Incorporated partner, out of retirement to head major parts of corporate credit trading. Fixed income and currencies, the biggest source of trading revenue, fell 36% to €988 million in the quarter and will be down for the full year of 2017 as the challenging environment continues, the bank said. The 5 biggest U.S. investment banks saw debt trading decline 22% in the quarter. Deutsche Bank moved some financing business from fixed income trading to another unit. The drop in revenue would have been 24% if adjusted for the change. The two co-heads of the investment bank, Markus Schenk and Garth Ritchie, are seeking to win back clients who reduced business with the bank late last year amid speculation about its financial strength. They're focusing the division on corporate clients while preparing to move assets in hundreds of traders from London to Frankfurt in anticipation of the UK's departure from the European Union. Equities trading was down 16%, compared with a decline of 0.5% at the U.S. banks. Deutsche Bank this month was left holding millions of dollars in stock of Osram Lichtag after failing to find enough buyers for a stake that Siemens AG sold in the company.